Okay, I am very happy to have back on the Goldstein on Gelt Show, Kimberly Foss, who is the president and founder of Empyrion Wealth Management and the author of the New York Times best-selling book, Wealthy by Design. Kimberly, a real pleasure to have you.
Hey, thanks, Doug. Thanks for having me back.
For those of you who didn't hear Kimberly last time, just go to youtube.com and look up Goldstein on Gelt and Kimberly Foss, and you'll find the interview there, as you will ultimately find this interview there as well. Kimberly, we are dealing with very, very difficult markets these days, and I don't know exactly what these days means now, but it seems to be very tricky. But I know that you sometimes talk about the good side of bad markets. Show me some light here.
Yeah, I mean, it's really difficult, Doug, and I know a lot of advisors are struggling with this, as our investors now. They're kind of having an awakening toward this volatility. But, you know, the reality is there is volatility in the markets, and we just haven't had it in a while, and so people aren't quite used to it again, and it's not fun. But wouldn't it be nice to get, like, say, a steady rate of return of 4% rather than all these ups and downs every year, is what I tell my clients. And they go, oh, yeah. And I said, yeah, well, be careful for what you wish for. Because, you know, the idea there of the volatility is we get to, you know, basically buy on discount. So kind of have three reasons what I go over with my clients to say, hey, you know what? It's important that the markets are volatile, and actually there's a good side to the bad side of, you know, volatile markets.
All right, let's hear what you got. Cheer us up with the good side.
All right, good side. You know, really the facts that, you know, the downturn in the market scare people is a reason why that stocks deliver higher rates of return than bonds. I mean, this is called risk premium. And, you know, if people aren't willing to pay as much for an investment that they're frightened to death of, then that money, that investment's going to go down. And the other side of that is us as being buyers, we get to buy that on discount. Sometimes I refer to it to my female clients as, you know, the Neiman Marcus 70% off sale. You're getting still the Louis Vuitton bag, but you're getting it for 70% off. I mean, how great is that, right?
Well, certainly from the buying side, it sounds good. But people who, let's say, bought a year ago who are now saying, oh my gosh, I must have made a big mistake. Do you think they did make a mistake?
Yeah, but the thing is perspective, right? Everything is in perspective, Doug. Over history, stocks have been fairly consistent, even at buying at relatively bargain levels, basically delivering higher rates of return than long-term bonds, you know, and cash itself. Just look at that S&P, you know, chart that you have. Small cap stocks outperform large cap stocks. Value stocks outperform small and large, and bonds and cash. And so, yes, maybe last year when you bought at higher highs than today, you're just going to buy today. And then, you know what? In 5, 10, 15 years, it's not going to matter, because you're going to look back at these times and go, wow, I got that for, you know, Google for cheap.
Or you won't even remember that the market had dropped now. It's true what you're saying, that on paper, when we look back, right, and we always tell people that past performance is no guarantee of future returns, on paper things look pretty good, and, you know, it's good to buy when the market's down. But let's say someone's in retiring years, or about to retire, or just retired. Do you think it's still appropriate to have a lot of exposure to the stock market?
Well, I think that's really where the first and foremost question is, what's your allocation? And that really drives and determines the variance in your portfolio, or your volatility. And volatility really affects your return long term. So if we quiet that noise through the allocation, so if you're, say, 5 years out to retirement, or you're just about to go into retire, you don't want to be, you know, 60-40 in that portfolio. You probably want to be more like a 40-60. And actually in this retirement time as well, maybe you're 2 or 3 years out, or you're just into retirement, which I have a lot of clients just starting retirement. Hey, let's keep 1 to 2 years cash on the sidelines to basically fund your retirement until we can get through this volatile times, and invest the rest for the long term. So, you know, when we're buying these on a regular basis, putting money in on a monthly, quarterly, you know, annual basis on all these downturns, you're basically buying, you know, hopefully near the bottom. But in the long term, you're certainly doing a better job of buying into the market than putting just a lump sum in there all at one time and trying to time that. And over time, this actually yields you more return on your investment, again, because your stocks, you know, have actually returned more than bonds in the long term.
We're talking with Kimberly Foss, the New York Times bestselling author of Wealthy by Design. She's also the president of Empyrion Wealth Management and, most famously, a return guest on the Goldstein on Gelt Show. A good friend of mine, Kimberly, has been talking about the good side of bad markets. Kimberly, I want to touch on something you said a minute ago, which is the idea of keeping a big cash reserve. And you actually said 1 to 2 years. I often tell people that the traditional wisdom of 3 to 6 months of spending in cash is not enough. You're saying 1 to 2 years. Do you think that's the right amount these days?
Well, let's actually qualify that, Doug, is that I was saying 1 to 2 years in the event that someone is just about to retire. Okay. If you're, 40, 42 years old and you've got 20 years out to retirement, no, not keeping 1 to 2 years in cash. You want to keep enough on the sideline, on the, powder drive on the sideline, so that you can, when the markets do come down 5, 10, 15%, you've got extra money to put in. But if you're, a year out of retirement or just going into retirement, keeping that on, 1 to 2 years on the sideline is a good idea, because ideally what that's doing is funding your monthly drip, right? So if you're wanting to take $2, $3, $4, $5,000 a month out of the portfolio, this is in cash. So you're not having to dip into the actual investments that are somewhat volatile at this particular time. Does that make sense?
Yeah, I think that's important. That was a good distinction between having an emergency fund, which everyone should have, and having
Right.
a cash retirement basket just to cover your expenses when you are in the in retiring mode. So,
And I do agree with you with the emergency fund. So those are two different things. The emergency fund, though, I really think that it's really important for people to keep at least a year on the sidelines, because you never know if you're going to lose your job. And especially if you're in your 50s and you lose that job, you may get a severance package that lasts 6 months, but you still may not be employed. And then that would really start eating into your retirement. And that's a critical times, right? From 50 to 65. That's very critical for investments. So you want to keep enough on the side.
Yeah, I'll just comment that even more critical for investing is the years when you're 20 to 30. If you can start earlier, squirreling away money every month, and the biggest mistake we see people make is they're working and they have a 401k plan at work, which they don't even bother participating in. They're not benefiting from the tax saving, and they're not benefiting from the matching their company often gives. I think the younger people can get going on this, the better for them.
I would concur with that. And in addition to that, I see the millennials, because they watched their parents go through 2008 and they're scared and they don't trust advisors out there. They're actually looking at more robo-advising than actual human beings, which I think is I mean, in the early days is fine, but not as you accumulate wealth. But they're statistically speaking, they're only putting about a third of the savings that they're putting away in the stock market. So, Doug, I mean, when we were in our 20s, I remember at Mother Merrill when I first started, I say that lovingly, by the way, I was 100% in the stock market. I was 100%. And up until, started maybe my late 20s, early 30s, I started putting a little bit of bonds into portfolio. But the only way to capture that wealth early, like we were talking about, is to be into the stock market. And you need to absolutely, my daughter just started a job in Austin, Texas, and we just did her allocation for her 401k, which her company is matching her 3%. I'm so proud of her. First job, 22 years old. And we did the whole allocation. Basically, she's 22. So we did about, 20% in fixed income and 80% into the stock market.
Wow, good for her, and good for you for leading her on the way. A lot of people who don't have parents who are financial advisors don't really get good advice, and when they're trying to develop good habits, they just can't. If you're meeting with a couple or a family who's just got bad financial habits, they're trying to change, what guidance do you give them?
Well, one of the things that I do try to is if they can acknowledge, where they're spending money. So it just starts out with the basics of, let's see where you're spending money. Let's just take a pencil or a pen into a yellow piece of paper and just write down, their last 6 months. That really is an eye opener. Once you get the parents on board and said, hey, wow, I really do need to take a look at this, and how can I help change my habits? That is the first step. If the parents are on board, God help the children, seriously. It's really hard. But if you have the parents on board, then what I do is I enlisted them and said, hey, let's bring your children in now and let's start coaching them early and often. And using apps like acorns.com. Great app. It rounds up purchases. So if you have trouble saving, even for, for an emergency fund, here's a way that if you go and buy Starbucks coffee for $3, you get to choose, you control this. So you can round it up to $5. That $1.50 goes into an investment account that you choose the allocation. Again, my daughter did this. And then, just $18 a week that it doesn't even feel like you're saving, yields $1,000 a year. So you could easily squirrel away, no pun intended, quite a bit of money without really feeling it. Does that make sense?
Yeah, and I think that's a great tool. Kimberly, another great tool I know that people could really benefit from is a copy of your book. Unfortunately, you and I are just about out of time, but I understand that for people who are listeners of the Goldstein on Gelt Show, they might be able to get a free copy of Wealthy by Design. Even if you'd be so kind as to sign it, could you just tell us how they could do that and how they can follow you and your work?
Absolutely. You can go on our site, KimberlyFoss.com, and sign up there. Send me an email. You can go Kimberly@KimberlyFoss.com directly. Just request that you listening to the show, and I'd be happy to send you an autographed book in your physical address, and we'll go ahead and send you one out from here.
Great. Okay.
You can buy two at BarnesandNoble.com and Amazon.com as well.
That's funny. It's funny when we also offer certain books for free to clients, and I noticed when we started doing that, all of a sudden more copies were sold. So I thought that was funny. So for those of you who are looking for good financial advice, free in fact is a better price than whatever you're going to pay on Barnes & Noble or Amazon. And are there any other websites that people should follow you?
My private wealth management side, which gives you a little bit more niches what we serve, which is www.empyrionwealth.com, EMPYRION wealth.com. You can do it, and also you can follow me on Twitter. It's Kimberly Foss CFP at Kimberly Foss CFP, and then I'm on Facebook and LinkedIn as well.
All right, so we will put links to all of that at the show notes of today's show at goldsteinongelt.com. Kimberly, always a pleasure to have you.
Thanks, Doug. Thanks for having me again.
You are listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.